Hello, and thank you for joining us. My name is James Whelan, and you are joining us for the Theory of Thing Investment Podcast. As mentioned, my name is James Whelan. It still is, it was before, and it will be forevermore. It's 3 o'clock in the afternoon on 30th the 8th, and I am live from the Barclay Pierce Capital Studios of Sydney 115 Pit. I am joined here by David Scutt, who has not been on the show for too long. StoneX? Are we saying StoneX or are we saying something else? StoneX?
StoneX at the moment, mate. So that sounds well, and great to be back, and great to be part of the South Australian contingent on the show.
I know. We had to keep it up. Heath is incapacitated. Today I'm not going to overcook the sponsorship or anything like that, but I'm going to have a wakey. I need to get myself back up in the afternoon. That is a lemon and lime flavor that's there. Let's see how that kind of cooks up. Just the caffeine hit that you need to get you through the afternoon on a Friday that we're going to get the show. I'm going to pump this show out. David, mate, how have you been? Let's get into it.
I've been good. It's been busy, obviously. Rather than being those sleepy summer markets that we see in northern hemisphere, been very different the past month. So I'm actually quite enjoying it. It's nice to see some volatility back, and I suspect we're going to see more of it coming forward.
Yeah, I mean, let's talk about what happened with the Bank of Japan. I mean, it's now the end of August. We're about to kick into September, October, November. So we're almost at the end of the third quarter going into it, mate. If you'd asked many people a month ago almost exactly what they thought was going to happen to the markets, I mean, it was a complete cataclysm. Were you as confident as it's easy to look back on now? I mean, run us through what the mentality was at the beginning of the month, mate.
The beginning of the month was that things were looking pretty shaky in the US economy. I can understand why there was so much concern out there. As for the unwind in the dollar yen carry trade, I think it was not so much about what was going on with the Bank of Japan. That was part of the equation. But realistically, it was more so about what had been happening in the lead up to that. And we'd seen constantly narrowing yield differentials between Japan and the United States. And it had been going on for months and months and months. And yet the carry trade kept going and going and going. Then all of a sudden, equity stopped rallying as well and started to go and get a bit shaky. And then the combination of that with the BOJ hiking by just a little bit more than expected and being pretty hawkish in its statement. And you saw what the aftermath was. That was a day to remember, up there with any of them that I saw on the desk back during the GFC.
Circuit breakers on the way down, and then circuit breakers on the way up on the next day. Jim Cramer with it. It's going to take a long time before we start to see these numbers back again. It took about 6 days. Thanks, Jim.
Yeah.
Even I'm generally pretty. I've just succumbed to all of the nonsense, and now I'm just my default setting is bullish, which turns out is actually the best way to be. And even by my just insanely cynic bullishness, not even I had that sort of ambition on what was going on, mate. What do you see coming through towards the year? I've seen 2 different types of headlines. One is saying that China kicking back on. We're seeing copper sort of starting to come back and rebound. If Heath wasn't on the chat right now, if Heath wasn't on the podcast right now, I can tell you right now he's on the chat saying that copper is definitely on the rebound and coming back from his deathbed that he currently is in now. And we wish him all the well and get back. But then you've also got headlines coming out saying that China's 5% GDP growth per annum is shaky at best. Where do you see that for the end of the year, mate?
Mate, it's funny you're talking about China because there's some headlines have come out, and we've heard these kind of things before about trying to go and stoke household demand and consumption and everything else. So Bloomberg's reporting, I think, just has just come out in the last hour or so, that China is considering allowing all the mortgages that have been written, about 5.2 trillion US dollars worth, to be refinanced at much lower levels. And I'm just looking here, I can see dollar yuan is trading at 16-month lows, and also China A50 is threatening a bullish breakout of its downtrend. So keep an eye on that one. We hear a lot of these thought balloons come out, but realistically, if you talk about copper demand, you're talking about housing demand, you're talking about consumption, you need to go and get that Chinese consumer back up and running. Well, I dare say that would be one way to do it. So is there smoke and fire? Well, at the moment, it's speculation, but keep a close eye on that one. If that does go and come out as being true, look out. That's going to be a big game changer for China.
That could be massive. Yeah, that would unlock. I mean, theoretically, that would unlock significant wealth for the Chinese consumer. What are we talking here?
Yeah, well, look, we know that housing prices, especially new housing prices, have been absolutely hammered recently. I think the year-on-year declines the steepest ever on record, and it's been several, like more than a year of declines coming through. So anything to go and turn that sentiment around, and going, more importantly, probably go and get that consumption beast going as well, would be really important. So look, it's a Friday afternoon, low liquidity, month end as well, but the volumes going through the Chinese market today are really, really high. So maybe there is something to this. We'll keep a close eye on it. But no, you talk about a game changer for what we're talking about, the global economy in the latter part of the year. It's pretty important if this is true.
Yeah, no, I'm with you on that one. Now, you did mention the US dollar in there when you're talking about the Chinese yuan. Mate, we've had Michael Jackson Hole come and go. Jerome Powell, isn't he? Isn't he? You'd buy him a beer, wouldn't you? So it's just a sensational work from him last week. Everything that we needed to see. Exactly the headlines that you needed. Exactly the sort of. I did joke about it on Ausbiz the top of the week that the only way that could have been more market friendly is if he literally released doves behind him as he was speaking. That's just how good that speech was, mate. What's your take for the US dollar going through into the end of the year? Just off the back, I mean, everyone says priced in, priced in, priced in. I'm not super bullish on the US dollar, but then we do have an election coming in at the end of the year. That's got some different ramifications going in. What's your take there?
Look, US dollar depends on what currency pair you're talking against. If it manages to go and manufacture a soft landing at the moment, and I think, despite what we saw in that July payrolls report that got everyone very nervous about what's going on in the States, a lot of the data that's come out since has been really, really strong. We saw like a 1% increase in retail sales that came through. ISM services was well and truly above 50 as well. So to me, there's a lot of pessimism that seems to be built in to the buck, and you still got over 100 basis points worth of cuts priced in over the remainder of this year, and nearly 200 over the next year. So to me, look, it looks a little bit rich at this point in time. The key thing is we've got to watch out for, and I won't give you a definitive answer right now, is because I want to go and see what happens next week with the payrolls report on Friday, because that to me is going to be the determinant as to how aggressive the Fed's easing cycle is going to be. But here and now, the data since that payrolls report looks all right. And so I think we've probably got a little bit too pessimistic on the dollar, certainly against the likes of the yen and the euro as well. If we translate that across to what the Aussie looks like and stuff like that, well, I think the Aussie might be able to go and grind higher in that kind of environment if we do get that soft landing.
It's funny that we sort of down this brings both of these circles around, and we've got the US dollar with the cutting cycle going on, so that's weak for the US, positive for the Aussie theoretically if you just have those pairs, and all other things being equal. You've also got the Chinese potential rebound that you've hinted is potentially going to be a thing with some volume behind it this afternoon. Yeah, could the Aussie go up even higher? And then what does that mean for our local guys?
I think so. It's really important what happens with China's currency, the yuan, is if it keeps strengthening, that's going to be like a linchpin. And every time it strengthens, you're likely to go and see the Aussie kind of move in lockstep. The correlation between the two is very, very strong and strengthening at this point in time, a negative correlation. So to me, it looks like it wants to go higher. At this point in time, very ultra near term. There's some stuff that suggests that maybe we've run a little bit too hard, too fast. But in an environment where you're talking about a pickup in the Chinese economy, you're talking about slow, steady downturn in the States, and then that soft landing, then start again. That's a pretty bullish scenario for cyclicals, and the Aussies at the forefront of that. So I'd expect it would outperform in that kind of scenario.
Yeah, I do often forget that when all things just get back to what it's about, that Aussie is just a good cyclical sort of, yeah, just a good cyclical sort of market, and that is. What about small caps, mate? I mean, if you go back before what happened in Japan, there was a big rotation that was happening out of the Mag 7, and it wasn't really the biggest rotation, but it was a small sliver of money exiting the Magnificent Seven, going into small caps, which was mega phony because that was actually quite a significant amount of money charging into small caps. It was really magnifying. Yeah, we'll go with that. Yeah, magnifying exactly how much small caps were increasing by. Do you potentially see that trade continuing on into the end of the year? Because I mean, all the same, the bed is still made for that trade.
Yeah, it was interesting to see the rotation from posting the video. We saw a little bit of a bounce in the Russell 2000 as well. It was up around about 1.5% last night, and then pulled back a little bit. I think the thing that's keeping people nervous is still that labour market in the States. There's still not confirmation that that things aren't deteriorating pretty rapidly. But if we were to go and see the data come out next week and look decent, and then the Fed still allows to go and start cutting, but do it in a measured manner. That's like the perfect environment for small caps, lower costs of capital, a reacceleration in economic activity. That's what those companies need. But in terms of what happened last night, the rotation from NVDA, where that capital went to, well, it was pretty obvious that it went to a lot of the other Mag 7 names rather than any parts of the market. But if we keep seeing that US data hold up, I dare say it'll probably look decent on a medium-term horizon.
I've been saying for the last year that it's funny that the US data has gone from being, you've had this string of really bullish data, or sort of, excessive inflationary data, growth data, to being sort of bearish, okay, recessionary data that's coming in. We've done the recessionary ones. Now we're on the bearish. I think it's possible that if we see a string of just insanely bullish inflationary growth data, that it might tweak some of what the Fed has been about. And I think that it might just rein back some of. I mean, if you want to talk about how many rate cuts were factored in at the beginning of the year, 7.
Yeah. It feels very deja vu, doesn't it? It feels like deja vu. The key difference on this occasion, though, like, and I absolutely ripped the other Fed at the time, because that was their victory lap, mission accomplished. And Jerome Powell, even though they were already signaling 3 cuts coming through, it was doing it at a time in the labor market was still clearly really, really hot in the States, at least based on what the numbers were, which we know were maybe a little bit more rubbery than what they were at the time. But the key difference this time is that there's clear weakening coming through in the labor market, which is why I'm a lot more confident and comfortable with what it's doing. So I'll be really surprised if we're going to see like a really steep reacceleration in inflation and growth and stuff like that in the near to medium term. But yeah, look, at the moment, the Fed and in the year ahead pricing is near enough 200 basis points. So what that equates to is a 25 every meeting out to September of next year. So where I sit it right now, and I think about what does that mean? Well, that is probably that's like borderline kind of soft landing. If it's doing like regularly, 25s, no panic coming through, to me, that's kind of the borderline. But if you go beyond more than 25 at each meeting, then you're starting to go and talk about, hey, something disorderly is going on. Like you think back, Jimmy, over time, over cycles, whenever the Fed's been forced to go and cut 50s or 75s or anything like that, it's never been during a good time.
There's always been a reason behind it. And that's what I said. It's just like, well, hang on a minute. So the bond market has at least one of these things being at 50.
Yeah, so for the end of the year, so there's 3 meetings left for the Fed, and in the 3 meetings, there's just a smidgen over 100 basis points worth of cuts. So the way the kind of implies is that either do like a 50, 25, 25, or maybe a 50 and a 50, then wait. But still, like that's punchy. And look, the counter argument is like, well, even if you delivered 100 basis points worth of cuts, you still have the neutral policy rate as being significantly lower. Policy would still be restrictive, but just not as restrictive as the past. But again, just the message that it sends if you're doing big ones, it's again, like from a psychological perspective, a confidence perspective, it would be doubtful if you're going and see a really, really positive response if we're doing 50s back to back to back.
Yeah, I can't imagine what would have to happen for a 50 to come out in the next few. Well, I don't think I want to imagine. I think it's going to be. It'd have to be a really a big thing. God forbid that the market might not be at all-time highs or near all-time highs. When the Fed wants to start a rate cutting cycle, and very gently. I mean, hey, Powell might just be one of the greatest Fed chairs of all time potentially. I mean, he's managed to navigate this. Credit where it's due, he's managed to navigate this one pretty well so far.
Yeah, and look, he's probably got a little bit of assistance as well. Like, I'm not going to go and pass judgment until we actually go and see in aftermath what happens. but look, we've seen disinflations taking place, and there hasn't been any massive carnage in the labor market as yet. It's pretty uneven. You can tell by some of the store results. Dollar General, a pretty famous one out overnight as well, that really talking about how the lower end consumers struggling. But he's also getting a lot of help. Well, help now, but maybe it was a real hindrance, up until probably the last 12 months or so from the fiscal side of the equation. The US government's still spending structural deficits, kind of 4.5%, 5% of GDP. That's massive fiscal impetus coming through at this point in time. So that's helping to cushion this blow, and we're still seeing disinflation take place. So maybe it's one part Fed, one part fiscal, but Those deficits, you can't keep running them with those magnitudes, particularly at a time when the economy is already strong. So we'll see what happens in the future. That's something to be concerned about probably for another day.
It is something to be concerned about. Thank you very much for that, Andrew. Thanks. Cheers. We stole this rugby ball from from someone that, that potentially. I hope that the under 16 boys at Shore School don't want their rugby ball back, as I'm doing all the practice on doing this back jibby challenge that we've got. I just got my new head of the new head of my Insta desk has just handed this to me, just gone, he'd rather that I was having a rugby ball with what I do. Now we've got the back jibby challenge that we're doing. Sorry, we'll get around to it as well. Thank you very much for that. Oh, there was one more thing that I was going to ask you, and it's just disappeared from my head. Oh, crap. I hate it when that happens. I was going to talk about local markets, local rates.
Yeah.
You want to skip that? Go.
No, we can talk about. No, look,
Yeah,
RBA's made it pretty clear and everything else that it wants to see further progress, and I think it's really trying to go and drag its feet. But you can tell the patience is wearing thin. I'm really interested to see in the GDP report that comes out next week. I'm looking forward to seeing what the domestic demand deflator, so kind of economy, domestic economy, what's going on there, what's going on with productivity and things like that, because they're the things in that report that the RBA is going to be looking at pretty closely. To see a rate cut by the end of the year, that's kind of more mechanical, I think, by what's going on offshore, and they're looking at what the Fed is potentially going to do. But yeah,
they can't be ahead of that. Sure.
The retail sales data that came out today was soft. It was like flat month on month, but you got to remember too that followed two pretty punchy increases in the other prior 2 months. So it's not time to go and ride off the consumer just yet, and we still really haven't seen the full effect of those tax cuts coming through. But it's Australia. We were so late to go and start tightening as well. It just feels like we're behind the rest of the world, and yeah, for the time being, it looks like I still feel that we're not going to go and be cutting rates this year. And if we do cut, it's not going to be because of domestic factors, because of what's going on offshore.
Yeah. I mean, even when you have something like the CFMEU with a national strike day, what is it, a day of action or something on Tuesday, that didn't cripple the economy, because every single bar, Ryan's Bar, Angel Bar, Republic, probably the Stab, I think they're in there too, and the Grand, sort of just all the pubs that are around my particular vicinity. There was more high vis in there than Perth Business Lounge, Qantas Business Class Lounge, mate, on a Friday afternoon. It was all CFMEU. The taps were run dry. We went into the where do we go into? Our new sort of our little place we like to haunt at the Republic an afternoon. Ran out of Carlton the next day. I was just like, yep, the unions drained it. It's just like, well, thanks, boys. I think that hospitality number is going to be insane for August.
Food and beverage consumption is going to be through the roof.
It's just, thanks, boys, for your service. You've crippled the economy beautifully, and in that particular regard, mate. Swans top of the table. We've got finals coming up next week. Quietly confident against Giants. What do you think? What's your take? Are we going to be having a Sunday afternoon in late September session, seeing the Swans play Port Adelaide potentially, the great enemy?
I hope so. I remember we had a chat right before the start of the AFL season. We're talking about GWS and the Swans being right up there in terms of the other teams that would be featuring deep into September. Look, the Swans are so hot and cold at the moment. If you're asking me, 3 months ago, I would have been like, yeah, we can handle it. But the one thing I look at the Swans right now is that we seem to be lacking a tall forward, a tall backman. We're one short. So we really struggle at the moment to go and contain tall forwards. And that's my concern. When we go, if we manage to go and get through the first round and then into the prelim, who will we be up against, and how many tall forwards are they going and throw forward? Because to me, the Swans have struggled in that particular area, and that's my concern at the moment. I don't think we shouldn't be flag favourites. You look around some of the other names, like Port Adelaide. Having watched them absolutely do a number on the other Swans in person a month or so ago, I can tell you that was the best first quarter I've ever seen a team play. It was just ferocious, the attack on the ball, and the Swans weren't working for each other and really compounded and made it bad. And then they've lost a couple of backmen as well. And then I look at Geelong, and Geelong's just that kind of sleeping giant that just has done absolutely nothing. No one was really talking about them. All of a sudden, they're in the top four. And then you've got these plucky team like the Hawthorns coming home with a wet sail as well. They're probably too young, you'd imagine. But yeah, it's really wide open. There's not a clear-cut favourite in my opinion, and certainly I'd love the Swans to be there at the end and holding the cup alive. But yeah, I don't have as much confidence as I did at the start of the season.
I would be looking forward to, and I've got things booked already at home, but I love the opportunity of if it's a Swans Giants grand final through some fluke, if they have to go, it can happen, can't it? They can go back around and meet each other back in the granny.
Yeah.
And then just be able to walk into the MCG on the day and get tickets. It'd be wonderful.
We'll see. Yeah, I think there's a lot of corporate friends and gifting going on in that particular neck of the woods. But yeah, having tried a couple of years ago and managed to go and jag one through an unlikely source, it was. I can tell you, it's very difficult if you're a fan. So let's hope that the ticketing goes to the true fans, not just the corporate sponsors and the like.
Yeah, mate. Now, look, we're not going to do any footy tips this week unless you've got anything in the NRL. But it's a big weekend ahead. I don't really have anything special to tip out there. What I do have is I'm doing this back Jimmy challenge where I've got to be competent in rugby. And I know that you probably would have played in school, or you would have played some stage over your career. Myself coming in as a complete amateur to the game, what advice can you give me? I've got to be competent. We've got our launch of our new fund, our wealth management offering, in early October. We're going to have a beautiful rugby game that's going to have ex-players playing, and I'm going to be right in the thick of it as well. I've said that I'm going to play wing. I think that the reason why I'm going to play wing is just so that if I get in trouble, just step outside the box and you should be okay, Jimmy. But look, I need to be competent. What advice can you give someone coming in as an amateur? It's all about being surrounded by people that know what they're talking about, David. I reckon I trust your advice on this. What do I need to think about?
Yeah, mate. Look, my first piece of advice would be in a different scenario to not participate, just to go and watch. That seems a lot more safe.
That's super sad, mate. The Rubicon has been crossed. We're done.
Yeah. But if you're going to go and do it, I'm not going to go and review your age, but you're around the same age as me. You're probably a touch fitter as well, has got to be said. But at our age, soft tissue injuries are very, very, very difficult at our age. So I would be making sure you're working your stretching, and then everything else will kind of fall into place. That way, at least you can move and you can dodge, because at that kind of age, yeah, you've got to be twinkle toes wheeling.
They can't hit me, they can't hurt me. As it. Thank you very much for that, David Scutt of StoneX, mate. That's sensational advice. Thank you for joining us today.
Pleasure to be here, mate. I look forward to coming back on the show at some point again.
Mate, we're gonna get back on the beers. I was supposed to be in Adelaide this week, mate. I'm gonna try and get that done as quick as I can, though. Okay.
Sounds good, mate. Looking forward to it.
Have yourself a good one. Thank you very much, everyone. You've been joining us on the Theory of Thing Investment Podcast. David Scutt of StoneX and James Whelan of Barclay Pierce Capital's Wealth Management Team. Any questions, comments, 5-star ratings, yada, yada, yada. Do what you got to do. We're going to get out of here. It's Friday afternoon, and it's time for a beer. Thanks very much.